Good morning, everyone. Thank you for joining our new F&W Sessions series. This is a new monthly webinar that we are hosting, covering key business issues with speakers from across our organisation. My name is Tom Shea. I'm a partner in the Business Tax Team. And today, for the first half of the session, I want to be covering the Corporate Criminal Offence for facilitation of tax evasion. As has been mentioned, there's an opportunity to ask questions on the panel, and we'll pick up questions at the end of this topic. I'm also joined by Justin Arneson, who is a partner in our Business Tax Team, focusing on R&D tax credits, and he'll be covering that topic later in the session. So, turning to our agenda. In the first session around corporate criminal offence, we want to cover off what really are the key elements of the CCO legislation and who it affects. What are the latest developments from HMRC in relation to the new legislation and how they're actually approaching dealing with compliance? What should organisations be focusing on as they approach their compliance programme, considering training and communications, and then taking questions and answers at the end. In relation to our R&D tax credits topic, we'll be recapping about what is R&D tax credits, what costs qualify for relief, what are the key approaches to maximise claims, some key takeaways, and then again Q&A at the end. So if I turn to my first slide and give an overview of the new rules. These rules came in around a year ago, introduced by the Criminal Finances Act on the 1st of September 2017. They were a response by the government to increasing concerns that they didn't have the powers to prosecute companies in relation to tax evasion activity. So there is a number of high-profile cases, particularly in the financial services sector, where employees of those organisations have been facilitating tax evasion of their clients and customers. And HMRC didn't have the powers to prosecute those companies for not having controls around their employees when they were facilitating tax evasion. So HMRC looked to bring in a new piece of legislation, which was a criminal piece of legislation, unlike other traditional pieces of HMRC legislation, and therefore had additional penalties and teeth in its application, and made the legislation very broad in its approach. So it covers all companies, partnerships, LLPs, including charities, and there's no de minimis in which the legislation applies. So all businesses in the UK will have to adopt a compliance process to ensure they're compliant. The application is also broad in its scope, so it covers both UK tax evasion and foreign tax evasion, and we'll cover that in a bit more detail later. At a high level, effectively the offence applies to businesses that fail to prevent the facilitation of tax evasions by employees or what's called associated persons. And we'll come back to the definition of associated persons later. The reason that it's very significant is because penalties are quite severe. So there are unlimited financial penalties for non-compliance for organisations, let alone the reputational damage being associated with tax evasion and potential regulatory issues if those organisations are in regulated sectors. I'll just turning to the next slide. Given this legislation has been in for almost a year now, it's been interesting to see how organisations have approached compliance, and indeed organisations that have not yet done anything yet. So already we've seen HMRC use the Criminal Finances Act, CCO legislation, to make prosecutions under it. So they've seized £350 million from a large UK banking organisation, again using the powers they have under the Criminal Finances Act. We've also seen an increase in the number of companies that have been referred to HMRC's tax evasion unit in 2017 offences. Again, the regime that HMRC has under the Criminal Offences Act has enabled them to identify where there has been facilitation of tax evasion by companies and actually press ahead with looking to investigate those organisations. This is part of a wider focus on tax evasion in the last few years. It won't escape anyone's attention that tax evasion and indeed avoidance have been on the front pages of the press and a lot of attention in the media as well. And really that means that for organisations it's imperative that they take this piece of legislation seriously. When it was first introduced, it was actually rushed out quite quickly by HMRC last year, and the draft guidance was only really released a month before the rules went live. So a lot of organisations missed the release of the legislation. And HMRC themselves admitted that they would take a relatively light touch approach in the first instance. However, the reason we're covering this topic today is because of the increase in focus from HMRC, that it's actually very important for organisations that haven't focused on it to date to make sure they've put in place the appropriate preparations to ensure they can be compliant. So I just want to take you through the 3 stages that have been set out under the offence around how an organisation could potentially be prosecuted. Now, it's important to remember at this stage that it's a criminal offence, so any prosecution would be tried in a court of law, and therefore it would really be down to a jury to decide whether the defences that the organisation has put in place are appropriate. The way a prosecution would come about is across these 3 stages. So the first stage is that there's a tax evasion offence, and that is in line with the existing tax evasion legislation. So what we mean here is there's a tax evasion by a taxpayer, which can be either a taxpayer or an entity, which is effectively an offence of cheating the tax authorities from revenue that they are owed. It applies both to UK and foreign tax evasion. The next stage would be for the organisation, HMRC, to consider whether there has been facilitation of that offence by an associated person of the corporation. The associated person must have deliberately and dishonestly acted to take action to facilitate the taxpayer evasion. And generally, this is a sort of key aspect that an organisation needs to consider. And we'll cover a bit more detail around who the associated persons of an organisation could be. Final stage is that there was a failure to prevent facilitation. And effectively this means that the organisation didn't have controls around its associated persons, for example employees, to prevent them from committing a criminal act. And the only defence that the organisation has to prevent being prosecuted is that the organisation had reasonable procedures in place to prevent the second stage from happening. Now, it doesn't need to be the case for stage 1 or stage 2. It has to be a case for the third stage to be conviction, from stage 1 or stage 2, the third stage to be prosecuted. And indeed, the tax evasion itself could have happened, but if the organisation has appropriate controls, then they would hopefully not be prosecuted in those circumstances. So the key message here is ensuring that the organisation has appropriate procedures in place to prevent facilitation from happening in the first instance. So who is an associated person? Again, the definition is quite broad, and HMRC have not specified a list of who they believe of who associated persons can be. However, they've encapsulated this in a phrase which is an associated person is anyone who is performing services for or on behalf of the entity. So if we think about this, that can be a pretty long list of people. So your largest group is likely to be employees. Also, contractors are likely to be a big population. But it could also include agents, introducers, outsourcers, suppliers, and indeed potentially joint ventures or subsidiaries. It's important to note that the associated person must have committed the tax evasion offence while they're in the capacity of an associated person. So what that means is, if, for example, an employee is working for a company and they commit an offence outside their employment, so something in their personal lives, then the company cannot be held responsible in that situation. And that's an important distinction to make when planning what procedures need to be put in place around the associated persons. One of the key first steps is identifying those groups of associated persons and to understand what procedures can be put in place in that stage 3 that we covered in the previous slide. So I just want to take you through a example here and a tax evasion offence to try and bring it to life a little bit. So we have A Limited, which is an organisation that is engaging contractor B for provision of services. Contractor B is then using a number of subcontractors to carry out the works for the A business. And they deliberately fail to declare their income through contractor B. Contractor B facilitates that through payments to those subcontractors in cash. In this situation, the A company is potentially liable for prosecution, and that is because contractor B will be an associated person of the A business. In order to defend itself in relation to the offence, A would need to demonstrate that it's put reasonable procedures in place, i.e. a risk assessment, specific contract terms between A and B, which might include that B is meeting all its tax obligations for all subcontractors, and ongoing monitoring and review. So we can see from this example that the rules are pretty broad in the way that they're applied and can capture companies almost very broadly, and so they will need to look across all their arrangements with third parties as well to consider whether they are at risk of facilitating tax evasion. I just want to spend a couple of moments just also considering the foreign tax evasion offence. So in the previous example, this was a situation which was solely based in the UK. However, a company in the UK can also be prosecuted if there is a foreign tax evasion offence. And in order for that to happen, there are a number of elements that need to be in place. So firstly, there has to be activity in the UK, either through a company incorporated in the UK or through a permanent establishment. Or thirdly, through a foreign subsidiary who has an employee who comes to work in the UK, who then facilitates tax evasion. And for the foreign tax evasion to occur, there needs to be dual criminality, i.e. that there is a similar tax evasion offence in the foreign country and a facilitation offence as well. Now, it's fair to say that in the vast majority of foreign jurisdictions, there is a tax evasion offence, and so those provisions will likely be in place to enable prosecution. What that means is that UK businesses need to ensure that overseas operations that they have, where there could be a potential for facilitation of tax evasion to occur overseas, they also have controls in place around that. That's particularly relevant when you consider things like invoicing, or where invoices could be routed through other low tax jurisdictions, for example, to avoid VAT, for example. And again, in those scenarios, businesses would need to have controls in place to prevent that. So just want to consider some of the protection and penalties. So firstly, considering the prevention procedures, HMRC has said that organisations need to take a number of steps, which we'll cover on the next slide, to ensure that they are protected. One of the key questions, one of the key activities that an organisation needs to undertake is to have a risk assessment undertaken to determine the impact on the business and identify those groups of associated persons and where those key risks apply. Once those risks are identified, the procedures can be put in place to ensure that the organisation has the protections from UK and foreign tax evasion. Just taking the penalties, I already mentioned earlier, and just to reiterate, there are unlimited fines associated with this piece of legislation. It would also be a criminal prosecution, so that would have implications potentially for directors of companies, and likely reputational damage given the focus on tax evasion in the press at the moment. In terms of how HMRC will investigate, we already heard earlier that they are referring an increasing number of organisations to tax evasion units and using their powers under the Criminal Finances Act to take monies. They only need to have a suspicion in order to commence an investigation. And through other pieces of legislation like the Common Reporting Standards, they are receiving increasing amounts of information from both the UK and overseas, which enables them to identify where tax evasion might be happening. I touched earlier on the fact that HMRC have identified a number of areas. There's effectively 6 pillars that HMRC have introduced to ensure organisations can bring compliance for themselves. First of these is a risk assessment, and I'll cover that in a little bit more detail on the next slide. The next one is bringing proportional procedures to manage those risks. Now, HMRC have made it clear that they're not expecting organisations to totally write new procedures in place. And actually, procedures that organisations already have in place for things like anti-bribery or AML, KYC, may be reasonable to also protect for facilitation of tax evasion offence. And so it's quite important that organisations consider what risk framework they already have in place and controls, and see whether any of those can be applicable to the risks identified under the risk assessment. In our experience, many of them do, but because it's very specific to tax evasion, new controls are required. The third area is commitment from senior management. So organisations are required to demonstrate that senior management within the organisation has bought into the fact that they are compliant. And what that effectively means is demonstrating on an audit committee or board report that a risk assessment has been undertaken, they commit to the findings of the risk assessment, and are introducing appropriate policies and procedures to govern the control for the CCO legislation. The fourth area is due diligence. So once those procedures are in place, checking that they're operating effectively. If there are elements that require additional focus, documenting those and ensuring that the organisation can demonstrate its compliance if challenged. It's vital to appreciate that perception is pretty important for this legislation. So when we've worked with companies to prepare for the legislation, it's clear that a lot of them have unwritten rules or policies and procedures that are undertaken, but they're not documented. And frankly, if a prosecution in worst case scenario was brought, it's quite difficult to defend an organisation without appropriate documentation. So making sure that documentation is in place is critical. The fifth area is communications and training, and that's effectively rolling out the policies and procedures and educating the organisation around how they've approached, how an organisation has approached compliance. And then the final area is monitoring and review. And this is almost the hardest area. Organisations often spend a lot of time when a new piece of legislation comes in to prepare for that legislation, and then can often forget about it or not actively act on it. And it's important as an organisation evolves and continues to bring in new aspects, whether it's making additional acquisitions, for example, adding new product lines, consider what controls they need for those parts of the business as the business evolves. I just want to touch on the reporting breaches. So under the requirements, an organisation is required to report breaches, both for the UK offence and the foreign offence. The UK offence they need to report to HMRC, and for the foreign offence they need to report to the Serious Fraud Office. We would recommend that if an organisation does think it's had a breach, then they take advice before reporting those breaches. But reporting breaches can reduce penalties. Just to touch on the risk assessment, HMRC has said that an organisation is very highly unlikely that they'll have any defence if they've not undertaken a risk assessment. So it's critical that organisations undertake that risk assessment and enable themselves to put in place the procedures. We've worked with a lot of organisations to undertake risk assessments using our risk assessment framework, and effectively what we do is work through to identify associated persons, consider the key risks in relation to those associated persons, i.e. what is the opportunity, motive and means for them to undertake facilitation of tax evasion. Opportunity is where that tax evasion might arise, motive is why it would arise, often financial, and means is how. And document those key stakeholders and then prepare a plan for ensuring compliance going forward. We have just included a slide here around training. So a lot of organisations are rolling out e-learning to train their staff in and understanding the legislation, and there's a test at the end of the e-learning to demonstrate compliance is another thing to build up that folder of documentation to prove that you're taking the legislation seriously. We've developed some e-learning, which is broken down into effectively 3 parts and takes around 10 to 15 minutes, and has been rolled out across a number of organisations. So it's a useful way of demonstrating and evidencing compliance for an organisation. So just my final slide just sets out how we can support organisations. So we've already covered the risk assessment, and after the risk assessment is completed, we can work with organisations to develop a risk framework, building on their existing control matrices that they have, and identifying those people who should take responsibility. Training and communication, we've done both in-person training and also e-learning modules. And then considering the CCO legislation in line with some of the wider strategy pieces. Finally, for organisations that have already undertaken risk assessments, we can perform health checks on those risk assessments on an ongoing basis as well, and help, again, with actual suspected breaches to HMRC. I will now turn to questions, and I'll ask Justin to pick up some of the questions that we've had in.
So Tom, yeah, I have a question. As an organisation, if I haven't done anything yet to comply with the legislation, what should I do?
So we've, seen a number of organisations recently who've come to us who haven't undertaken anything in relation to legislation. And sometimes they are in a bit of a panic because they're concerned that this legislation has been introduced for a while. As I said earlier, HMRC took a relatively light touch approach when the legislation first came in, but now are increasingly focused on organisations that haven't undertaken preparations. So the first step is to undertake a risk assessment, as I outlined, and identify a plan through to compliance covering off those 6 pillars that we discussed earlier.
And Tom, who should be involved from within the organisation when planning the risk assessment?
That's a good question, and one that often it's the one that no one wants to take on to actually take ownership of the legislation. I think it's important that a number of people are involved in an organisation, so that would include the person responsible for tax, finance function, legal and compliance, and operations. And often it's a combination of those teams that can work together to enable compliance.
I guess, Tom, you sort of touched on tax evasion in the press at the moment. Is this legislation just designed for large financial service businesses?
Yeah, that's a common question that we get asked, and I think it's fair to say that financial services organisations and indeed professional services organisations are potentially the focus of this legislation and the reason why the legislation was introduced in the first instance. But actually, the legislation is very aggressive and quite broad in its application. And so actually all organisations, all corporates in the UK need to comply. Now, HMRC's focus may initially be on the larger organisations, but if they do discover that there has been tax evasion in any organisation or at any level, then they will investigate after that, because I think really they want to demonstrate that they are focusing on tax evasion at the highest level. Indeed, they, for example, said that the contracting industry is another particular area of focus for them at the moment. Thanks for everyone's questions on CCO, and for any questions that we didn't manage to pick up, we'll come back to people individually. I now want to pass over to Justin to take us through R&D.
Thank you, Tom. So just, I guess, following on the introduction from earlier, my name is Justin Arneson. I lead the R&D practice here at Smith & Williamson. I have significant experience globally in terms of assisting organisations with regard to maximising and claiming R&D tax incentives. At the moment, the focus here is in the UK, but we have helped multinationals claim in various jurisdictions, as the rules are generally very similar. So this slide here is quite complex, and I guess what I'll be doing today is taking you along the journey in terms of what is R&D tax, how is it defined, categories from eligible criteria to eligible businesses, etc., moving into qualifying expenditure and talking about the benefit at the end of the day. The regime itself, the regimes were introduced in the early 2000s, so we're coming up to 20 years, almost 20 years. So I would say R&D tax is somewhat becoming commonplace. At a high level, we have 2 regimes. We have a regime focused on SMEs and a regime focused on large companies. At a high level, the definition really is you are considered an SME if you have less than 500 employees and either turnover of less than £84 million or gross assets under £72 million. If you meet that criteria, you're defined as an SME. If you don't meet that criteria, you're defined as a large company. You need to be a limited company to make a claim, And some of the other considerations that we need to take down the line are, have you received any subsidies or grants? Are you a subcontractor? And is the expenditure tax deductible? I'm now going to flip onto the next slide where I'm going to talk you through more of the process in terms of what is actually R&D for tax purposes. So the eligibility criteria from an activity perspective is defined as where a company seeks to advance a field of science or technology through the resolution of scientific or technological uncertainty. So that is a comment or statement or piece of legislation that government has released 20 years ago. As I say, it's commonplace, not only in the UK but globally. And often when I meet with organisations, they say to me, Justin, well, this actually doesn't apply to me. We're not advancing science or technology, and we're not resolving scientific or technological uncertainty. So in this flowchart below, I've tried to simplify it, almost break that definition down to the practical applicability of that definition to effectively come up with what is deemed to be core eligible R&D activities. Okay, so this is the first step that we would go about after we've distinguished between whether an organisation is an SME or a large company for tax purposes. Regardless of your company classification, this is the consistent definition that needs to be met by yourself. Okay, so right at the top, I guess the starting point is, are you developing any new products, processes, materials, devices, services, or software? That is the starting point. In addition to that, are you extending the knowledge or capability within your industry? So simplistically, the way I think of it is, are you developing anything that's new, or are you improving, whether it's the quality, the reliability, the functionality, or the performance of a product, a process, a material, a device, or software? Or are you increasing knowledge within the industry? And that's what is dubbed or themed as an advance. Okay, so this is generally quite broad, and most organizations, for whatever reason it may be, will be constantly pushing the boundaries to remain competitive. So in order to advance science or technology as the first point of this eligibility criteria, generally speaking, we perceive that to be quite easy to obtain or overcome that threshold. Where it becomes a little bit more complex is that next pillar down within the funnel, is that advance needs to be overcoming what is called scientific or technological uncertainty. Okay. Something that is not considered to be scientific or technological uncertainty is challenges or problems that competent professionals could easily resolve. Okay? Or could these competent professionals refer to publicly available information to overcome that uncertainty? So when I'm interacting with clients and meeting with technical people, the first thing that they say to me is, well, Justin, I'm not overcoming scientific or technological uncertainty. And my comment to them really is, when you experience a problem, what is the process in which you follow to overcome that uncertainty? Simplistically, if you could refer to a body of knowledge, or if you could interact with colleagues or competitors in the industry and you spoke to them about the problem or the situation or the objective that you were either trying to overcome or achieve, would they be able to easily explain to you the process in which you should follow to overcome that uncertainty? I then asked questions such as, are those uncertainties trivial? We then move a step down within this funnel and we look at activities. In order to overcome these uncertainties and ultimately achieve the advance of the objective, companies need to follow a systematic, investigative, and experimental process. That is one of the conditions that needs to be met. Once we've gone all the way down this funnel, we come up with something which is called core eligible R&D, and that's the activity that we would consider or look to make a claim on. Once we have an eligible activity, we then need to understand what costs we can claim or associate to that activity. The regime here in the UK is extremely prescriptive, and HMRC has put in specific categories that one needs to claim under. The first one and the largest generally is staffing costs. So these are people within your organisation, your staff that are, whether they're generally technical people, responsible for either overcoming that uncertainty or aiding in that process. So these are engineers, software developers, business analysts, solutions architects, etc. These are core people that assist in the resolution of that scientific or technological uncertainty. In addition to these individuals, we can also look at claiming any support personnel that facilitate or aid in that process. So these could be bid managers, commercial people, in some cases financial and HR people that assist the technical individuals in overcoming that uncertainty. We then move to software licenses. So software licenses are generally any piece of software that an organization uses in order to aid their development of their R&D activity. So simplistically, if you were in an engineering environment, organizations might be using CAD or BIM models to aid in their development works, their R&D activities. We would be able to claim a portion of those costs, of those license fees, in relation to the activity itself. I then move down to what is known as consumables and materials, and these are any items that are either consumed up or used or transformed in the process of the R&D. So simplistically, that could be any utilities, water, power, electricity, etc., or alternatively, it could be any hard physical materials. Those materials themselves cannot be then on-sold to an organization. They either have to be scrapped or disposed of as part of the R&D process. In the bottom left, we have a category called outsourced R&D. Okay, so this is when you, as the key driver within the project, connects with or contracts to an outsourced provider to assist with your R&D development. In terms of outsourced R&D, we have two categories. We have subcontractors, and we have another section which is known as externally provided workers. I'm going to dive into a bit more detail around these two sections because they do have an impact and there is a difference between the two. If you, as an organization, are deemed to be an SME for R&D tax purposes, you can claim both subcontractors and externally provided workers. However, if you're a large company for R&D tax purposes, you can only claim for externally provided workers. So what is a subcontractor and what is an externally provided worker? Well, let's start with an externally provided worker. So an externally provided worker is deemed to be any individuals or organizations that come into the R&D project, work alongside you, work under your supervision, direction and control, and aid in the development. Whereas a subcontractor is when you outsource work to a specialist organization and you do not have skills or competency to actually perform that work. Okay, so some organizations still think that's a bit blurry. So I was sitting with HMRC and we came up with quite a simplistic example to differentiate between the two. Okay? And the example is as follows. If I had an issue with my vehicle and I took my vehicle to a mechanic and I said to them, there's a problem with my car, I don't know what the problem is, please can you fix it? And the mechanic ultimately fixed the problem. For me and for HMRC, that is deemed to be a subcontracting relationship. I do not have technical expertise in that field. I went to a specialist. The specialist resolved the problem for me. If, however, I was a mechanic myself, I understood my vehicle, I understood the problem, I diagnosed the problem itself, and I went to a mechanic and I said to him, I think the problem might be X, Y, or Z. Please can you assist in the process of fixing my car? Because I have the technical expertise, that relationship may be deemed to be an externally provided workership relationship and therefore eligible if you are a large organization. So right at the top of this flow diagram effectively is we've got what is known as qualifying R&D activities. And just to recap, that is any activity or R&D activity whereby an organization seeks to advance science or technology through the resolution of scientific or technological uncertainty. So developing new products, processes, devices, improving on existing products or processes, and or increasing the knowledge. Once we have identified the qualifying R&D activity, we move down into the expenditure. An expenditure within an organization is either deemed to be revenue expenditure, so revenue in nature that flows through your P&L, or capitalized expenditure that hits your balance sheet. If you cast your mind back to the eligible expenditure categories, we generally look at staff, software licenses, consumables, materials, and subcontractors. If that revenue expenditure that is deemed to be eligible flows further down and you're an SME for R&D tax purposes, ultimately there's two potential benefits that one could claim. If you're profit making, you receive an additional deduction at 130%, when multiplied at the tax rate gives you a net benefit of, say, circa 25 to 26%, depending on the tax years in which we're looking at. Okay? So simplistically, that offsets any liability that you would ordinarily have to pay to HMRC. However, if you're loss-making, and some startups are loss-making, and conduct R&D in order to get their products out to market, HMRC have introduced what's known as a surrenderable credit, and that credit amounts at 14%, effectively getting a cash repayment coming through at 33%. If you're a large organization and you're still within that revenue expenditure realm, there's a scheme that's in place which is known as Research and Development Expenditure Credit, or RDEC. From January 2018, the incentive itself has moved up to 12%, and effectively that's an above-the-line treatment, which effectively gets treated as revenue in nature and then is later taxed. Okay? So we say the net benefit comes through at 9 to 10%. If you have capital expenditure that relates to qualifying R&D activities, and that gets capitalized ultimately on your balance sheet, there's a system in place called Research and Development Allowances. This is an in-year deduction or write-off at 100% of that cost. So very similar to your capital allowances incentives that take place, and this is in addition to and above that. So what are some of the recent developments that have been happening? So we've been engaged with HMRC most recently, over the last 4 weeks or so, and these are some of the 6 key developments that they've put forward to us and the wider industry. So we talk about processing times and claims taking significantly longer. What I mean by that is HMRC has come out saying that due to the increased number of claims during peak periods such as March, December, etc., they have not been able to respond to taxpayers or pay credits. And at this point in time, there's a backlog. And that backlog related to March claims. And they've advised us that all March claims would have been cleared by the end of July. The impact really now is what will happen to organisations who have submitted claims in June, July. At what point will those claims be cleared? In addition to the backlog for SME claims, there's still currently a backlog on RDEC claims relating to periods ended December and March. HMRC have committed to clearing this backlog by September, and one of the instructions that we've been told is that organisations and agents themselves should not contact HMRC until the end of September, October to follow up on any claims. HMRC have also come forward and suggested that the quality of technical reports that are currently being submitted to substantiate or justify claims are not sufficient. Some of the feedback that we received is that whether it's taxpayers themselves or agents are not providing enough technical information around what activities have been undertaken and why those activities meet the technological or scientific advanced threshold and scientific or technological hurdle. They've also asked that when claims are submitted over more than one period, organisations not been enough interaction in preparation for these reports with competent professionals. So these are the engineers, the technical people, the software developers, etc., that are actually undertaking the R&D activities. If we move across there, HMRC in the coming months, probably moving into early next year, are going to be launching some awareness campaigns. As I said earlier, this regime's been around for almost 20 years now, but there's still a lot of taxpayers that aren't maximising or actually making claims themselves. The industrial strategy has been released, and HMRC, from an R&D perspective, are trying to target tech companies, software companies, renewables, infrastructure, and agricultural sciences. So there will be road shows over the coming weeks to try and encourage taxpayers to put claims forward. As part of this increased awareness, government is in the process, when I say government, HMRC is in the process with consultants to introduce new software guidelines. We have seen draft copies of these guidelines and are in the process of working with HMRC to refine them. This is quite a positive step from our perspective, as the last time the guidelines were updated in terms of relevant examples, etc., were back in 2008, 2010. So there will be some specific new guidance released in relation to software, and I guess that ties back into the industrial strategy and the drive towards supporting tech and software organisations. Back in 2015, HMRC introduced what is known as an advanced assurance scheme. Effectively what this is, in its current form, is a mechanism for SMEs to go to government and seek pre-approved R&D claim, which covers a period of 3 years. So instead of it being retrospective, it is prospective. As I say, it was introduced in 2015. And in 2016, there were only 229 claims that have went in. And just to put that in some sort of perspective, really, ordinarily there's probably 16,000 R&D claims that go in every year. So the uptake has been very low. They expect that to drop. And at the moment, the findings or the numbers for 2017 are down at 27 advanced assurance claims. So we're working with government at the moment to either consider expanding the advanced assurance scheme to large organisations. So my own personal view really is, if government wants additionality, and ultimately that's what they want when they introduce these type of mechanisms, these advanced assurance schemes would provide taxpayers, regardless of them being SMEs or large co's, with the clarity and certainty and predictability that they would be able to bring into the fore with R&D tax incentives. So the last point really at the bottom is, historically this has always just been around R&D tax incentives. There's been a gap between other incentives that exist. Early next year, or at least by the end of the first quarter, government wants to introduce a new innovation forum that will not only cover R&D tax incentives, but will be including things such as Innovate UK grants and patent box, effectively enabling clients, organisations, taxpayers and government to understand the various incentives that flow across the value chain. So how can we help? We're a services-based business, really, so we provide various types of functions and advice and outputs to clients, ranging from feasibility assessments, so that's increasing or raising the profile of R&D within a business. We often use a feasibility tool to consider R&D reliefs versus R&D allowances. This is really prospective, forward-thinking types of things, which ultimately can then be used as a tool or a dialogue with HMRC to hopefully de-risk any claims that go forward. At the moment, we're doing quite a few health checks or diagnostics, where we assist clients with reviewing existing or past claims to identify opportunities for enhancements, identify any risks, and then ultimately submit amended returns. So when I talk about opportunities, it could be around some organisations not looking at all the divisions, not looking at all the projects, not including all of the relevant people, and that might be branched out to qualifying indirect activities, etc. We're also working with organisations to plan in a prospective manner for future R&D, and this could be assisting with ensuring that commercial arrangements are set out appropriately, classification of outsourced activities if you're a large organisation, cast your mind back to EPWs versus subcontractors. We do this in order to try and maximise cash flow and forecasting. As with most organisations or providers of R&D tax services, we then do the full end-to-end service, which is preparing and submission of R&D claims to government, and that process is a thorough process whereby we introduce the concepts to the various organisations that we work with. It is our responsibility and role to engage with your team and conduct technical interviews, scrutinise these projects, challenge them from a technical perspective, and then consolidate all the associated expenditure, prepare the reports and submit to HMRC. What we've also been doing quite a bit of is dealing with inquiries, and those might be predominantly our inquiries that come from taxpayers submitting applications themselves and not fully understanding who needs to be involved with the definitions of R&D. We have a strong relationship with the HMRC teams, and we do this to ensure that claims are de-risked and processed as quickly as possible. In this slide here, I'm just going to briefly touch on added value over time. This is something that happens when we all work with organisations for an extended period of time. We understand and become more familiar with the organisation, and the organisation becomes more familiar with the R&D tax incentives. So the starting point, I see my role as reducing one's risks of providing detailed technical reports, HMRC compliance, full defence. As we start working with organisations for a longer period of time, we try and refine that process to reduce time, to further mitigate risk, and to ensure that the onus of time, etc., sits with us rather than your technical people. For the more forward-thinking claimants, we assist with regard to forward planning, and as I mentioned, that could be assisting with factoring in R&D into tenders, contractual considerations, building in real-time models, so claiming R&D as we go along rather than retrospectively. And this maximizes R&D claims because you're identifying the activity and the amount of time that one spends as you go along, which ultimately leads to increased cash flow. And where we want to get to in terms of leaving a legacy is creating enough skills within the organisation and a knowledge hub with R&D champions so that they identify projects as early on as possible in the process and raise the profile to the executive. So I wonder if anyone's got any questions for me, Tom. Come through.
Yeah, we've probably got time for a couple of questions. So one question that we've received is, if my competitors have done something similar, does this mean my development is ineligible?
Tom, the long and short of that is no. So maybe I'll answer that with an example. I was working with one of the banks who were the first to develop a banking app, and that was new proprietary IP ultimately that went into the marketplace. And then I was approached by bank number 2 who developed that app, and they came to me and they said, well, Justin, yes, this app is in the marketplace. We want to do it to remain competitive. Does that mean that my R&D is precluded? And my comment to them was, no, it doesn't. Just because something exists within the market does not mean that you cannot claim for that activity too. In this particular example that I talk about, the underlying systems in place and the way in which this organisation developed the second banking app meant that it was R&D in its own right. So if we just cast our mind back, if the information in terms of how to develop that solution and what uncertainties you would overcome is in the public domain, that might mean that it is ineligible.
We've also had a question around the cost and the patient of those costs. What happens if they're outside the UK and they qualify?
Yeah, so in the UK, the regime here says that the activities themselves can be based anywhere. So the activity can be based outside of the UK, so you could have third parties working for you in Europe or Africa or anywhere else, provided that expense goes through a UK entity, you can claim for that cost in the UK.
Thank you. Thank you, Justin. Thank you, everyone, for listening. We hope that was useful. As I said at the start, this is the first in a series of sessions that we are running going forward. Next month, some of our colleagues are looking at employment and taxes hot topics, so we hope you can join us for that. The invite will be coming out shortly, and we'll be making the slides and recording available from today's session for people who want to access it later. Thank you very much, and goodbye.